Well, a warm welcome everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned financial planning firm in Brisbane. Today we have Sean Fenton from Sage Capital. Sean is a managing director and founder of Sage Capital. Sean's highly experienced in fundamental and quantitative investing, with more than 25 years of industry experience managing Australian equity investment mandates. Prior to founding Sage Capital in June 2019, Sean was a portfolio manager at Tribeca Investment Partners for 14 years, where he managed the Alpha Plus Long Short Fund since its inception in 2006. Prior to Tribeca, Sean spent 7 years at AMP Capital as a senior portfolio manager, co-managing the Quantitative Equities Fund. Sean commenced his investment career at Credit Suisse, where he spent 4 years evaluating companies sell side and providing equity strategy research. Sean holds a Bachelor's of Commerce in Finance with first-class honours from the University of New South Wales and is a graduate of the Australian Institute of Company Directors. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statement regarding the financial product for further information. Details about this general advice warning can also be found at the moneysmart.gov.au website. Thanks for joining me today, Sean. As a fund manager specialising in Australian equities, can you talk us through Sage Capital's history and investment philosophy?
Yeah, sure thing. Sage Capital was formed in 2019, so we've been going for about 5 years now, but there's a much longer track record behind there. So there's 5 of us at Sage with a diverse skill set as well. So our investment process incorporates both quantitative, so more systematic measures of investing where we rank stocks by momentum, value and quality, as well as fundamental investing. So we really get down to the weeds, try and understand how companies make their money, do some more detailed modelling, do more detailed valuation work, and try and get some really high conviction ideas. So we've got those 2 aspects, quant and fundamental, and those skill sets are actually dispersed within the team as well. So we've got a range of different skills there.
So when you're doing the quantitative and the fundamental analysis of the investment process, is that systematic or is that more discretionary in nature?
Yes, the quant's very systematic. So we've literally got terabytes of data there on company earnings forecasts from all the brokers, all their financials. And what we're trying to do there, our overall philosophy is we're on to understand earnings and where they're going, because over the medium and long term, it's really earnings that drive stock returns. There's a lot of noise in the middle there, animal spirits and macro and different thematics and trends, and that can make it difficult in the short term. So we want to try and control risk there and strip it out, really focus on where earnings are going. And we're trying to do that both systematically on the quant side. So we've got that database and we'll be trying to identify trends in earnings, so looking at earnings momentum, how different brokers are upgrading or downgrading, changing recommendations and technical and pricing and things. But also we want to balance that with valuation. So earnings momentum's great, upside's great, but if a stock's becoming more and more expensive, if you get that wrong and there's a downgrade, suddenly it falls a long way. So we want to dimension things with valuation and risk as well. So the quant side's very systematic. We take all the data in every day, we're crunching it, calculating these factors and ranking stocks across the market from best to worst. But then the fundamental side, we're trying to do the same thing, but the quant's got some limitations. It's, we're looking at trends to forecast where earnings are going to. Not great at identifying turning points or something very particular that's happening to a company. You can't get as much detail in terms of valuation. So that's where the fundamental side really comes to the fore. We've got a very experienced investment team. There's, I don't know, probably like 70 odd years of combined investment experience. I've been kicking around financial markets since the 90s. So we understand the Australian equity market very well. We get out there and talk to companies, we talk to their competitors, understand what's happening, both top-down, market structure, competition, where margins are going, where a company's operating financial performance may be, where their incentive structures lie. So we really have a good feel for what's important in terms of driving their earnings, but we also do some more detailed valuation, financial modelling and work as well. So the fundamental sides, we're trying to approach it in the same way, but a lot more detail, a lot more forward-looking, a lot more granularity, and that lends itself to some high conviction ideas. So we're trying to combine the two of those. We're ranking stocks on the quant side. We rank everything. It's a good starting point, but getting a lot more detail and information with the fundamental side in terms of a deeper understanding of the company, valuation, and earnings outlook.
Okay, so once you've ranked the stocks, how do you then assess risk when you make the investment decisions?
We do a couple of things. Probably the most important thing is we make life a lot easier for ourselves by breaking the market up into different chunks. So the ASX 200 is our primary focus, and we break that down into what we call SAGE groups. So we've got 8 of those. They're defensive stocks like supermarkets or telcos, domestic and global cyclicals, so retail, builder, travel, mining services all fall within there. Resources, a lot of commodities in Australia, so BHP, Fortescue, all those sort of things. We strip gold out of there. That's quite volatile and behaves a little bit differently. Then we've got growth stocks that have higher PE, so tech and healthcare, everything from your Xeros and WiseTechs, REAs to CSL, Cochlear, ResMed, fall within growth stocks, so higher multiples but well performing. REITs, pretty self-explanatory, and yield stocks is banks, insurers, things like Carty Bank, diversified financials like Computershare, Challenger, those sort of things. So we split the market up into those 8 groups, and we're really looking to go long and short within each of those groups, but keep our exposure to them to be quite neutral. And that means we've automatically controlled a lot of macro and a lot of style risks. So if you look at what really blows up funds, it's generally, they might do really well because they might be very value focused and value is working really well, but then the world changes and it does very poorly, or growth and everything else. Or they might take a big bet that banks are going to outperform resources, and they do for a while, it switches around or they get it wrong. So we're trying to control all that macro risk and allow our broad investment process to come through in the stock selection, our understanding of earnings, relative valuation within those groups. So that's the primary thing that we do to control risk and deliver more consistent returns. Then we've got a risk model sitting behind there as well, where we look at the broad correlation structure of the market. We put constraints on liquidity, so smaller, less liquid stocks, we take smaller positions. More volatile stocks will take smaller positions, and we'll also look at how those stocks will correlate across the market to make sure we're not taking unintended risks in any different areas. So that combination of the SAGE groups, neutralising those, and then a risk model to spread things around liquidity and overall stock-specific risk.
Okay, so what are the opportunities and the risks that you see in the current investment marketplace?
Yeah, I think those things go hand in hand. I think some of the risks and opportunities, the market's getting stretched in a couple of dimensions at the moment. So the market's been increasingly dominated by passive index flows and ETFs and thematics. We're probably at quite a euphoric stage in the equity market as a whole at the moment, and we're seeing a lot of inconsistency building up, particularly in things like the relationship between the bond and the equity market. So last year was a pretty good year for equities, despite a lot of expectations of recession, just never happened. We had quite a strong bull market, and that was really aided by the US Federal Reserve cutting interest rates at the start of the year, inflation coming down, market getting pretty excited about that. The equity market continued to get excited about that through the year, and we saw valuation multiples really expand, but the bond market went the other way. So bond yields have started moving back up towards their highs. We've seen a lot of new supply coming on. The US is running a big budget deficit. The Fed, whilst they're cutting interest rates, they're actually still doing quantitative tightening. So the big balance sheet of government bonds that the Fed's built up through both the GFC and QE 1, 2 and 3, but also doubling down in COVID, they're allowing that to run off as it's maturing. So there's actually quite a supply of new treasuries that need to be funded, and that's pushing up the term premium. So real bond yields are moving higher. And that's generally an environment where the equity market and valuation multiples would come under pressure. But through the second half of last year, they really went in different directions. So that's both an opportunity and a risk. I think it's a risk for the overall market if that dynamic keeps going on. The rubber band's being stretched out and out, and eventually it snaps back. And the opportunities we see from some of that is probably some normalisation of some of the extremes that have built up through the market. So a few of them that really jump out at me straight away is obviously within yield. So remember, for us, that's banks, insurers, diversified financials. Within there, banks have become very expensive. And in particular, CBA sticks out like a sore thumb. It's the best quality bank. It's got, obviously leading mortgage franchise. It's got a funding cost advantage with more free transactional deposits, technology leadership, but it's now trading on like 25 times earnings and doesn't really have any growth. Like Australian households are pretty maxed out in terms of debt. There's no real upside in terms of net interest margins. Competition's not going away in a hurry. Bad debts, whilst they were sort of written back earlier in the year and gave some earnings upside, they're very low and they can't go negative. Well, they were negative as bad debts were written back. So there's ongoing costs in terms of labour costs, compliance costs, technology costs, regulatory costs. So it's probably long-term more downside bank earnings and upside. So they'll be really struggling to grow, paying 25 times of that capital-intensive regulatory risk, downside tail risk if you do have a recession. That makes no sense. So if we see a bit of reallocation from equities back to bonds or a bit of pressure on market valuations, CBA actually looks very vulnerable to that. We've seen it in the market. Whenever you have bad days, CBA actually underperforms in the bad days. So that passive flow, the weighted index money, industry super funds trying to cover their risk has all driven a technical sort of valuation bubble in CBA despite no earnings multiples. So earnings growth. So that's an opportunity. And we're seeing similar things across the market. So some of the growth multiples are looking a bit ritzy in the tech space. Probably have a preference there for some of the healthcare names like, say, ResMed, that's still trading on like 25 times earnings. GLP-1 uncertainty created some opportunities there. So we see some more upside there. Plenty of upside within resources and commodities. So we're pretty not bearish on China, but we don't see a lot of upside in terms of overall commodity price, in terms of super cycles. Their investment in infrastructure and real estate's peaked out. The exporting of steel's peaked out. So steel demand's sort of flatlining to down, new supplies coming on. So we're a bit more bearish on iron ore, but there is, despite the slower take-up of electric vehicles, there's still that energy transition going on. And as we move through towards the back end of this decade, increasing demand for copper and aluminium, and there's just no real new supply, particularly of copper, coming on. The market's been avoiding commodities through the end of last year, but there's some long and short opportunities that we see popping up there as well.
Okay, so you talked about some of Sage's fundamental and quantitative analysis aspect, and also your 8 models that you use. But what are the other strengths that Sage Capital has as a fund manager?
I think the real strengths really come back to the team and the people. At the end of the day, investing is about decision making. And I think one of our real strengths is how our team comes together and makes decisions. So we've got broad experience across the market. We've got skills within quantitative and fundamental investing, but we've got a very experienced investment team where we've all, at various stages, pretty much covered all stocks across the ASX 200. So we've got different areas of primary responsibility. So those 8 groups we talked about, we focus a little bit more individually on each of them. But when we come to make our investment decisions, we really come together as a team and analyse companies in terms of their strengths and weaknesses and risks. So one of the biggest impediments to good investment outcomes is confirmation bias, groupthink. People sit around, or you divulge responsibility. Okay, it's your responsibility to invest in this. You've only got one person looking at it, or everyone sits around and nods, or the leader's a bit too strong, just whatever he says goes. So my team doesn't really respect me, so they just constantly disagree with me, and we have some really good discussions. There's always someone playing devil's advocate. So I think as a team, our dynamic's good. There's a lot of experience. We make good balanced decisions where we're looking not just at the upside, but the downside and the risks around our decision making.
So talking about downside, can you talk us through a period when you've turned a period of poor returns into an investment opportunity and turned the performance around?
Yeah, look, one of the downsides of investing is you're always at some stage going to have poor returns and a drawdown. So it's important how you deal with that. The first thing to do is recognise what's going on there. Is it a bunch of individual stocks where you've made poor investment decisions, or have you taken on a risk in the portfolio that you were unaware of or didn't intend? So the first thing you need to do is understand what's going on there. And for us, we had a period like that at what are we now, 2025? So at the end of 2023, the fund had a bit of a drawdown. And the reason for that is coming out of COVID with inflation, interest rates going up, expected more of an economic fallout from higher interest rates in terms of unemployment, house prices down, some more casualties there. And we're probably a little bit too defensive across the portfolio and relatively too negative a view on earnings and where they were going. So despite being reasonably neutral across our sage groups, there's been a defensive aspect that crept into some of our decision making. And what we saw through that period is that inflation started to come down, people looking for maybe rate cuts. The economy just held up a lot better than expected. I think the fiscal expansion side outweighed the monetary contraction. So we had to sit back and go, okay, we've got this wrong. We need to readjust things. So let's start out, reposition the portfolio, look for the new opportunities, and that worked well for us. And so performance recovered to there, back above our high water marks and everything else. So sometimes it's that broad market exposure. Sometimes it can be an individual stock. So like ResMed's a good example of that, where we've been quite bullish on ResMed for a long time in terms of its leadership in sleep apnea and CPAP therapy there, its long-term earnings growth. But with the advent of GLP-1s, Ozempic, Wegovy and the like, treating obesity and potentially reducing incidence of sleep apnea, the market obviously got very worried about that. And we'd spent some time looking at it and decided that the risk was actually pretty marginal in terms of actually being able to cure people of sleep apnea just with weight loss alone, particularly with ageing populations and everything else. So sort of maybe like 5% downside to that. But the market completely panicked or got very excited around Ozempic, and all the healthcare stocks, and particularly something like ResMed, really got punished. And we had to control our risk and cut a bit of exposure. But we spent the time doing the work, doing more analysis, talking to a lot of experts, and came to the conclusion that no, we were right the first time. The market's just overreacted to this. It's really more at the margin, and built that position back up again, and they've continued to deliver earnings, and the stock price is back near record highs, and it's been a good performer for us. So sometimes it's about sticking to knitting and reaffirming where you were.
Okay. Can you talk us through any of the recent investments that you've made within the portfolio?
So we're always rebalancing the portfolio, making new investments. I think one that was it's probably topical the last few days. It's done very well for us over the last year, as we're quite early on recognising the upside to Goodman Group for its data centre potential. So the stock we know reasonably well, and like their model of third-party capital, their ability to develop their land assets, rezone them, good industrial property developer. But they had this sort of hidden pipeline almost of data centre, good industrial sites with access to power, which is critical for building data centres. And they're actually quite advanced in their planning in terms of rolling out data centres, and their model of using third-party capital to help do that, generate high returns on capital, was quite positive. So we recognised that reasonably early on, and went quite material overweight Goodman Group, which has been quite good for us. Obviously, more recent developments are questioning that, but it's actually an area we see AI, just broadly computing, data centre demand going forward, continuing to drive growth.
With keeping up with everything that happens in financial markets, how do you stay up to date?
Some of it comes down to experience, some of it comes down to systematizing things. So that quant part of that process takes automatic data feeds and crunches that every day. But we also rely as much as possible on third party and parties and leverage the resources that are out there. So we've got strong relationships across the broking community. So they've obviously got big analyst teams looking at stocks out there. So we rely on their research and leverage off them where required. We use sometimes third-party experts to get access to former employees of companies or competitors, get insights into markets. But essentially, we read broadly. But one of the most important things is there's a lot of information out there. One of the real skills of investing is recognising the importance of information. So we scan a lot of information quickly, but having a good understanding of what drives a company's earnings, what's important to it. One of the keys is not just gathering as much information as you can, but identifying what information is important. And sometimes I'm still surprised that sometimes people, they see a bit of information, they don't recognise what it actually means in terms of how it can drive a company's earnings and outlook.
Yeah, easy enough to do.
Mm.
Now, what makes a good portfolio manager, in your opinion?
I think it's a balance of things, and it's an interesting balance of sort of ego and humility, risk taking and conservatism. So I think you need to have enough confidence in yourself to take risk, and a lot of people actually aren't very comfortable doing that at all. But you can't be so overwhelmingly confident that you can't acknowledge that you might be wrong and look at the downside. So it's a willingness to take risk, but in a balanced way where you're recognising that you might be wrong and that you should consider alternatives. And we do that essentially with diversification. So those sage groups, they control a lot of macro risk, but we run over 100 active positions in portfolios, so 50 or 60 long, 50 or 60 short, and recognise that we'll get things wrong, but by doing it consistently and broadly, that our investment process will shine through. So a good portfolio manager, I think, a willingness to take risk, but recognising the need for diversification and being able to acknowledge when you've got something wrong and cut it and move on.
Okay. So, Sean, we've covered a lot of ground. Anything else you'd like to add?
No, I think you've exhausted me, but thank you.
Sean, I appreciate you making the time to talk with me today.
Pleasure. Thanks for having me.
If you'd like to talk with Solace Financial regarding if your current financial strategy is suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time, Sean. I really enjoyed hearing about you and Sage Capital and your investment insights.